Imagine this. One of America's biggest aircraft leasing companies, the people who literally decide which jets airlines fly, signs a deal worth $2.2 billion. But here's the twist. Not for Boeing, not for Airbus. Instead, they're buying 20 passenger jets from China. Pause for a second. Why would a U.S. giant with access to the world's top planes put that much money on a little-known Chinese jet? Is this just a clever business deal? Or are we witnessing the first cracks in an industry that for half a century has been ruled by only two names? Think of it like Pepsi suddenly putting billions into a new soda brand nobody has ever tasted. Risky, bold, maybe even crazy, but impossible to ignore. This single move has stunned the aviation world, because behind those headlines is a much bigger question. Is the global balance in the skies about to change? And to understand why this news shook the industry, we first need to go back to the story of how the skies came to be dominated by just two giants. For decades, commercial aviation has been a two-player game. On one side, Boeing from the United States. On the other, Airbus from Europe. Everyone else? Just spectators. It started with Boeing leading the jet age in the 1950s. The Boeing 707 made intercontinental flights routine. Then came the legendary 747 jumbo jet, a plane so iconic it became the face of global travel. Airbus entered later, in the 1970s, as Europe's answer to America's dominance. Their A320 revolutionized short-haul flying, while the A380 Super Jumbo proved Europe could match Boeing in ambition. Between the two, they built not just planes, but an entire system of trust. Airlines didn't just buy jets. They bought into safety records, pilot training programs, global spare parts networks, and resale value. When an airline chooses a Boeing or Airbus, it isn't just buying metal and engines. It's investing in $10 billion of trust, parts, and people. That's why, for decades, airlines had little reason to gamble on outsiders. Market share numbers show it clearly. Boeing and Airbus controlled nearly the entire commercial aircraft market. Everyone else, Russian, Japanese, Brazilian, even Canadian challengers, remained on the sidelines. This duopoly didn't happen by accident. It was earned through decades of proven reliability and global presence. And that makes the stakes for any challenger enormous. And that is why breaking in is brutally hard. So why is breaking in so hard? Because building a modern passenger jet is one of the toughest engineering and regulatory challenges in the world. Think about it. A jet is not a single product. It's a flying ecosystem made up of millions of individual parts. From engines and wings to wiring and software. Each one has to function perfectly at 35,000 feet, where mistakes can cost lives. And then there's the supply chain. A single jet might involve thousands of suppliers across dozens of countries. Engines from one place, avionics from another, composites from yet another. Coordinating all of this is like conducting a global orchestra. If one instrument is out of tune, the whole performance fails. But even if you build the plane, you're only halfway there. You must prove to regulators around the world that it's safe. That means millions of hours of testing, wings bent until they almost snap, engines run until they nearly melt, software hammered with simulations. Then comes the paperwork, mountains of it, to satisfy aviation authorities in the US, Europe, China, and beyond. History shows how steep this climb really is. Even advanced countries like Japan, Russia, and Canada, with decades of aerospace experience, have struggled to get new jets fully certified and widely adopted. Some programs ended quietly. Others limped along with only a handful of buyers. That's why experts often say, building a jet isn't about making an airplane. It's about proving reliability, again and again across the globe. So when China announced its own big jet project, many dismissed it as a long shot. But step by step, flight by flight, something began to change. China's answer to the duopoly came in the form of the C919, a single-aisle jet designed to compete directly with Boeing's 737 and Airbus's A320. The project was officially launched in the late 2000s, backed by state ambition and billions of dollars. At first, most of the aviation world treated it with skepticism. Could a newcomer really challenge half a century of dominance? The early years were slow and painful. Engineers spent over a decade in research and development. On factory floors in Shanghai, teams worked long nights assembling prototypes, stress-testing wings, and fine-tuning systems. Progress was steady, but doubters kept calling it a paper airplane, something that existed more in press releases than in airports. That changed in 2017 when the C919 made its maiden flight. It wasn't flashy, just a cautious takeoff and landing. But it was symbolic. A machine that many thought would never leave the drawing board was suddenly in the sky. From there, the grind continued. More test flights, more tweaks, endless certification work. Year after year, the plane inched closer to proving itself. By the mid-2020s, something else happened. Orders began to pile up. Airlines inside China were first, but interest started to ripple outward. What was once dismissed as a state vanity project had crossed an invisible line from dream to reality. Each flight test, each signed order, added weight to the idea that this wasn't going away. And then came the shock that made even skeptics pause. A major U.S. leasing company put money down. In aviation, not all buyers are equal. When a single airline orders a few planes, it makes headlines, sure. But it doesn't always move the market. Airlines have unique needs, national loyalties, and political pressures. Their choices can be dismissed as one-off. But leasing companies? That's different. These are the quiet giants of aviation. They own thousands of jets and rent them out to airlines all over the world. Think of them like landlords of the skies, shifting planes between tenants depending on who needs what. Their job is to bet on aircraft that will hold value across borders and years. That's why the GE Capital Aviation Services order was such a bombshell. A U.S.-based leasing titan agreeing to spend $2.2 billion on 20 C919s is not just a purchase, it's a signal. Because when a lessor places a big order, they aren't just buying for themselves. They're saying, "We believe others will want this too." Their choices ripple across the industry, shaping what smaller airlines dare to try next. To put it simply, if an airline orders one jet, people shrug. If the keeper of thousands of planes places a bet, the market listens. That's why this deal felt like more than a business contract. It was a credibility stamp, one that said the C919 was worth paying attention to, even outside of China. But the obvious question followed. Why would GE make that bet? What made this new plane worth the risk? When you strip away the politics and the headlines, the reasons behind GE's bet on the C919 come down to three very practical factors: price, availability, and Boeing's struggles. First, the numbers. The C919 is cheaper than its Western rivals. Boeing's 737 MAX or Airbus's A320neo can each list for well over $100 million per plane. The C919 comes in noticeably lower. Multiply that across 20 jets, and you're looking at hundreds of millions in savings on capital costs alone. For a leasing company, that's not pocket change. It's the difference between a risky gamble and a calculated investment. Second, timing. Right now, both Boeing and Airbus have massive production backlogs. Airlines placing orders today might wait years, sometimes a decade, to receive their planes. That's like paying for a new car and being told it won't arrive until 2035. The C919, being newer and with production ramping up, offers something invaluable: earlier delivery slots. For airlines desperate to expand fleets quickly, that's gold. And third, Boeing's recent troubles. From the 737 MAX crashes to ongoing production delays, Boeing's reputation has taken hits in recent years. Each delay costs airlines money, each safety headline dents confidence. While Airbus is stronger, it too is booked solid with orders. That leaves a gap, and the C919 slips neatly into it. Of course, there are risks. The C919 doesn't yet have decades of reliability data, a proven global support network, or the same resale value as Boeing or Airbus jets. But for a lessor like GE, the trade-off is clear lower upfront cost and faster delivery versus the comfort of sticking with the old guard. And there's one more twist. The C919 may be branded as China's jet, but it's not built in isolation. In fact, it's stitched together from the same global industry it's trying to disrupt. Here's the irony. The C919 is branded as China's great leap into aviation independence. But peel back the layers, and you see a far more complicated story. Modern aircraft are global machines, no matter whose flag they fly under. The C919 is no exception. Critical systems, from engines to avionics to materials, come from an international web of suppliers. Western firms, Asian firms, joint ventures, they're all inside this plane. In fact, you could draw a pie chart of its components and see something striking. While the airframe and final assembly happen in China, many of the beating hearts of the jet, the parts that keep it flying safely, are tied to global partners. And that reveals a messy truth about the industry. On paper, countries compete. In reality, they cooperate because the business incentives are too strong. A Chinese jet may carry American engines. A European jet may use Asian composites. Rival governments argue, but their companies quietly profit from working together. Imagine an engineer in Ohio designing a component, a technician in Shanghai installing it, and a pilot in Africa eventually flying it. That's how intertwined aviation has become. The C919 is as much a symbol of global interdependence as it is of Chinese ambition. This is why the stakes go beyond just one plane. It's about how politics, economics, and engineering clash, and yet still end up tied together. So the big question is, what happens if the market starts to truly accept the C919? So, where does this leave us? What happens next if the C919 begins carving out space in the skies? There are three main scenarios. Scenario 1, fast adoption. If the C919 delivers on time, proves reliable, and stays cheaper than Boeing and Airbus, it could win rapid market share, especially in regions where cost and speed matter more than tradition. Think of fast-growing airlines in Asia, Africa, or the Middle East that need planes now, not 10 years from now. Scenario 2, a slow climb. This is more likely. The C919 wins steady orders in China and nearby markets, but struggles to break into Western airlines because certification is slow and resale value is uncertain. It becomes a strong regional player, but the duopoly mostly holds. Scenario 3, a setback. If major issues appear, delays, quality concerns, or political roadblocks, momentum could stall. In that case, Boeing and Airbus consolidate their grip, and the C919 becomes another almost challenger, remembered like other failed programs before it. So, what should we watch next? Key milestones will tell the story. Global certification wins, the first international airlines to take deliveries, how leasing companies position the plane, and whether Boeing or Airbus adjust pricing to fight back. At the end of the day, this is bigger than just airplanes. The C919 is a test of how global business and politics bend when money, ambition, and capacity collide. And now, I want to hear from you. Which scenario do you think will play out? Fast adoption, slow climb, or setback? Drop your thoughts in the comments. I'll be following this story closely, so hit subscribe if you want the next deep dive. Whether it's on certification, engines, or how airlines actually fly these jets, the sky is no longer owned by two.